What's up everyone, it's Karthik with MoneyVest. So I've got a very big announcement and a huge important video here to make. And in this video, we're going to be talking about a brand new financial model that you can use on our MoneyVest platform to calculate the net asset value for any business. Or in other words, the net liquidation value, so NLV, for any company. And this has by far been one of the most trusted and most deep value investing models that has stood the test of time and was first introduced by Benjamin Graham of The Intelligent Investor, which then Warren Buffett used in his practice and principle of investing in the market. So we're going to be discussing the net value investing strategy, and that was developed by Benjamin Graham using the net current asset value per share, or NCAVPS, as a primary measure to evaluate the stock based on its balance sheet. And according to the net strategy, the ability to generate revenue from current assets is the true value proposition of a business. Current assets, which are used in the net approach, are defined as assets that are cash and assets that can be converted into cash within 12 months. That is accounts receivables and inventory. But there is some limitations, and some of the critics essentially mentioned that the net investing strategy does not consider long-term assets or liabilities, making it unreliable for long-term investments according to its critics. And that's exactly what we have solved on our platform. So what we have done is not only give you the ability to calculate the net asset value or the net liquidation value for any business, but we've also given you the ability to account for those long-term assets and liabilities as well. So if you come over to this, you'll notice Ben Graham's net stocks and a 7-step checklist to make money with nets. So if you scroll down a little bit further, it's a value investing technique where the stock is valued purely on its current assets, cash, accounts receivables, inventory, and then you subtract debt. We've taken it a step further. We've given you the ability to basically do whatever you want with that analysis. So if you come over to our analyzer tool on the MoneyVest platform, now we've included for this net liquidation value calculator, which is super cool. I've been using it. If you come over to this NLV, so now you've got the balance sheet of the entire business and you've got a recovery rate that you have to plug in. You can model this into your own analysis and then figure out what is the net liquidation value for any business. We'll go over that in just a minute, and I'll explain how that works. So again, if you scroll down a little bit, the formula to calculate NCAV, which is the net current asset value, is simple, and the idea to find stocks where the NCAV is higher than the market price. Because if you really think about what we're trying to accomplish and do here, is that we're trying to find the actual asset value for the business, or in other words, the liquidation value. And if that liquidation value is higher than the market price, it does not make sense. It absolutely doesn't make sense, because why would the assets be worth more than the actual market value of the business, right? That's a huge dislocation and a huge discrepancy in the overall market. It's like saying that, if you have a company with $100 million of cash, let's say that you're running a company with $100 million of cash and no debt. You have no liabilities, you have no debt, you don't owe money to anybody, and you just have simple $100 million of cash in the bank account, and the market is valuing your company at $50 million. That doesn't make any sense, right? Because why would the market be valuing your company at below cash value, right? Below asset value. So that's what we're trying to figure out here, and that was the deep investing value strategy of Warren Buffett and, of course, Benjamin Graham. And to get the per share value, you simply divide the total asset value or the liquidation value and then divide it by the shares outstanding. Now, this right here is simply going over the net current asset value. So again, the keyword here is current assets, because as we discussed earlier, according to Investopedia, this is Benjamin Graham or Warren Buffett's strategy to calculate the business net current asset value. But the criticism has been that it does not account for long-term investments or long-term assets and long-term liabilities, and that's exactly what we're going to do. And we've given you the opportunity now with this model to either calculate with long-term assets and liabilities or without. So what we have here is essentially the balance sheet of the business. In this example, we're analyzing Twilio. Twilio is a company, just focusing on automation and robotics. So what you'll notice is that we've got the balance sheet, we've got the assets, and this is the most recent quarterly number. So this is, you can see, as of June 30th, 2024. So cash and cash equivalents for Twilio sitting at $755 million. Short-term investments of over $2.3 billion. Long-term investments, $541 million. Property, plant, equipment, this is net after accounting for depreciation, $262 million. Accounts receivable, $537 million. No inventory because this is not a product company. Goodwill of $5.2 billion. Intangible assets just under $300 million. Other current assets, $310 million. Other non-current assets, $203 million. So you got total assets sitting at $10.5 billion for the business, right? That's their balance sheet. That's how much assets they have. If you scroll down, this right here is going to be their liabilities, right? Long-term debt sitting at just under $1 billion. Accounts payable, we got other current liabilities, other non-current liabilities, accrued liabilities, current portion of the long-term debt, and total liabilities of $1.8 billion. So now that we have total assets and total liabilities, what we are going to do is we're going to calculate the recovery amount. And the recovery amount is nothing but if all their assets and liabilities were liquidated, right? How much can we recover, right? So think of it this way. If you're running Twilio, if you're the owner of Twilio, as shareholders, we are technically owners of the business, part owners of the business. If we were to liquidate the entire business, how much can we recover? So for example, cash and cash equivalents should almost always be 100% because you can pretty much recover 100% of cash because it is cash. And what are we recovering to? We're recovering to cash only, right? So cash can be converted to cash because it is cash. So recovery rate can be 100%. Now, when it comes to short-term investments, it is the same thing. It is, T-bills or treasury bills or whatever the case might be, very, very liquid and very much converted into cash fairly quickly. Same thing with long-term investments as well, as most companies decide to invest in US treasuries that are maturing in over 1 year. So the first three things, I'm going to keep that at 100% recovery because these are very liquid investments that companies are making and they can quickly convert those things into cash. Now, property, plant, and equipment. And this is where things get quite interesting, right? This is where I want you to play around with this model to calculate the net liquidation value for any business. So property, plant, equipment, whether it is an office space, whether it is a building, whether it is infrastructure, equipment, whatever it is the company owns, if they go out there and sell that in the open market, if they go out and sell computers and desks and chairs and building and the factory or equipment, how much can they recover? How much can they get it back? Now, this is not going to be super accurate, so that's why it does require some level of estimation. So let's say that the company is able to recover 50%. You can plug in 50% here, and then that $262 million multiplied by 50%, we get $131 million in that recovery amount. If they go out there, sell all their property, plant, equipment, furniture, computers, everything, they're able to recover 50% of that. So $131 million. Accounts receivables. So this is everything that their customers owe them, Twilio as a company. So how much can they actually recover in terms of accounts receivables? I like to go up to as much as 75%. So let's say 75% of their accounts receivables, they're able to recover from their customers. So that's just over $400 million. Inventory, the company does not have. So in a product-based company, so for example, if you're analyzing for Apple, they'll most likely have inventory here. Then you're going to have to plug in that number for, okay, how many iPhones can they sell from their inventory, whether it's 40%, 70%, 80%, how much of their inventory we can recover from. Let's say that they've got $5 billion worth of iPhones sitting on the balance sheet, right, as inventory. How much of that can we get rid of if we were to go out there and start liquidating? If we were to sell all of that, how much can we recover? That's the analysis that we're trying to make here. Now, goodwill is an interesting one because it's an intangible asset, right? At the end of the day, it is patents, it is trademarks, it is maybe another company that they've acquired. So $5.2 billion of goodwill. Now, there is some level of estimation that is required here because at the end of the day, like I said, it is intangible asset. It is not a physical real asset. It is only intangibles like trademark, patents, different licenses and different acquisitions that they've done. So you can either keep it at 100% because they can sell these patents and trademarks to maybe another business that's going to be interested, or you can keep it to 0%, or you can be somewhere around 50%. I personally like to keep it around 50% because it obviously does not have zero value. It has some value. And even if you're able to recapture or recover half of that, that is still a reasonable expectation. Intangible assets, same thing, right? It's not a tangible asset, meaning something that you can't touch or see or feel. It is like a intangible patent or trademark or copyright or something that has like its inherent values derived from something that is not physical. Other current assets, again, you can go up to as much as 75% for this, and other non-current assets, we can go up to as much as 75% for this as well. So overall, we come up to 69%. So that $10.5 billion of total assets, if you were to go out there and liquidate Twilio, we can get $7.3 billion. This is just an estimation. I want to be very clear. This is purely an approximation here. And when it comes to liabilities, what I like to do is I like to pay down all liabilities. So just like we're expecting for recovery rates for assets to be a little bit lower than 100%, but when it comes to creditors, I'm expecting them to basically ask for 100% of payment, right? So long-term debt, we need to clear that 100%. Accounts payable, or whatever money we owe to our debtors, we need to pay down every single one of it. So $61 million, 100% of that. Other current liabilities, 100%. Other non-current liabilities, 100%. Accrued liability, 100%. Current portion of long-term debt, 100%. Again, you can play around with these numbers and you can, put 50, 75, 80%, 90% with your understanding of the business overall. You can play around with these numbers. And now you've got total liabilities of $1.8 billion, total assets of $7.3 billion. So the net liquidation value for this business ends up being at around $5.5 billion. And the shares outstanding at 170 million. You just simply take the net liquidation value divided by the shares outstanding, and you get a NLV per share, or net liquidation value per share, at $32.41. And since Twilio right now is trading at $61, it is over 100% higher than what its net liquidation value is. Why? Because of the earnings growth potential, because of the market's potential expectations from Twilio as a business over the long term. So they're pricing in, of course, higher multiples because they believe the company has significant potential to earn more money, cash flows, revenue, all that stuff. So it's not trading at book value. It's not trading at its asset value like no other business should. And that's the discrepancy. If for any case, if Twilio ends up trading below $32, and actually there was a time when Twilio was, I think at one point, trading below its net liquidation value. So if you come over to Twilio right now, it's trading at $61. I remember going over this stock not too long ago. In fact, I think over here, it was trading at $52 a share back in June of 2024. And at one point, it was trading at $49. I think it was around this time. Yes, I remember November of 2022. When it was trading at around $40, $41 a share, it was trading very close to its net liquidation value. And that's what this calculator allows us to do, is to really calculate what is going to be the net liquidation value for any business if it were to go out of business and we were to liquidate all the assets, pay down all liabilities, what is left over. And that's what this calculator helps us identify. And if you find a stock, if you come across a stock that is going to be trading below its net liquidation value, then you got yourself a very good potential deal. Of course, this is not the end-all, be-all financial model. You still have to do further analysis and research on the company overall. But if you've done your analysis and estimations, approximations correctly, and you find and come across a company that is trading below its net liquidation value, you've got yourself a good potential bargain that you still have to, of course, analyze. So for example, if I do 0% here, 0% here, 0% here, 0% here, 0% here, 0% here, now you look at $43 a share is where it ends up with the net liquidation value. But I don't think we can do that. Why? Because we still need to pay a significant amount in terms of the liabilities, right? Now, in today's day and age, in today's market environment, it is very, very difficult, incredibly difficult to actually find a business that is going to be trading below its net liquidation value. The reason being is because markets are incredibly overbought right now. We're trading at very high multiples, and a lot of businesses are most likely not going to be trading at or below their net liquidation value. For example, Apple, at 100% recovery of all of their assets and 100% pay down of all their liabilities, the net liquidation value comes at $3.02. That makes sense because they've got total assets of $311 billion, total liabilities of about $264 billion. So we end up with $46 billion divided by the shares outstanding, and we arrive at $3.02. So obviously Apple is never going to be trading at those levels because its assets are only $311 billion. So it's basically, in other words, it's trading at over 10 times its asset value, right? It's trading at 10 times its asset value because the market cap is well over $3 trillion, whereas the total assets are $311 billion. So it's trading at 10 times its asset value. So this is a model, this is a calculator, which is a deep value investing model where Benjamin Graham, Warren Buffett like to look at the businesses, look at the asset value, and then compare the market value with the asset value. And if you're able to find something that's trading below its asset value, then of course it starts to become a very good bargain or discount or deal, or a little bit of a dislocation in the market. It really is a way to identify some discrepancy in the market's efficiency of identifying a business that is worth trading at higher levels. So let me know your thoughts down in the comment section below. You can use this on our financial models here on the MoneyVest website. Again, there's a 16% annual discount that's available, and if you do ever come across a stock that is trading at below its net liquidation value, please do let us know. I would love to do more research analysis on this, so go ahead and analyze over 17,000 stocks and see if there's any businesses that are trading below their NLV. Hope you all enjoyed this video, found it helpful. Make sure that you drop a like, subscribe to the channel, and as always, happy investing. I'll see you all in the next video.